In this week's video, we'll cover a Nasdaq signal that has only been triggered 4 previous times in the last 23 years. We've covered numerous charts in recent months, similar to the one on your screen. The purpose of these charts is to help us differentiate between volatility to ignore within the context of an existing uptrend and eventually volatility to respect that may, based on our system and our time frame, require some reallocation or defensive action. And when we go through an exercise to figure out if the market backtracked to this level here from a closing high in this region here, it helps us understand that the market could fall approximately 10%. And even if it did that, we wouldn't have experienced significant or really any relevant damage to the uptrend. And that's relevant to making money because uptrends make a series of higher highs and higher lows. And the concepts covered in these videos have basically said, based on the evidence that we have in hand, it is prudent to try to think long-term and hold our positions. Because we know volatility, even within the context of the strongest trends, is 100% normal and to be expected. We don't want fear of drawdowns on the left side of the screen to derail us when we're trying to navigate between a point A and a point B that could hypothetically be several years down the road. A chart like this helps us with the concept of normal drawdowns and can prevent us from over trading. On the other side of the ledger, we also want to always continually ask and answer, does the data that we have in hand today align with or contradict the secular trend thesis? And in this week's video, we'll ask and answer another question. The 6 signals that we're about to cover, do they align with the material that we've covered in videos since May of this year? Or do they contradict the bullish topics that we've covered on the right side of your screen? The blue line is the 3-week moving average of the American Association of Individual Investors sentiment data. AAII bulls, the percentage of bulls minus the percentage of bears. It is extremely rare for sentiment to get down to these levels down here, here, and here. In fact, we've only touched this thin blue line on the bottom 3 times dating all the way back to 1986, and we're looking at all the data we have. First time, 1990. This is an oversold condition. Second time, 2009. The third time the 3-week moving average came down that far, 2025. And it's hard to see because the bounce back was so rapid, but the 3-week moving average of this sentiment data made it all the way back to this blue horizontal line recently. So we wanted to know, when we made a similar round trip in the 90s and a similar move from point A to point B after the major low in 2009, how did the stock market perform walking forward? The answer is quite well. February 15th of 1991 is similar to this point here in 2025. The same can be said for August 7th of 2009. In both cases, the stock market was higher a year later, 3 years later, 5 years later, and 10 years later. Average gains, 11%, 33%, 84%, and over 220%. And this is relevant because it helps us understand and assess probabilities related to this topic. What can we learn from the past actions of some traders relative to assessing the possible future actions of other traders? Traders and investors became extremely pessimistic. They became extremely pessimistic and extremely pessimistic. And then something happened in the news cycle that changed their mind, changed their mind, and changed their mind. In 2025, it was that the tariff news became less bad. So what can we learn from the past action of some traders that pushed sentiment from this level to this level, about the possible future actions of other traders, because in the past, additional investors continued to push stocks higher behind the original traders and investors that helped push sentiment from here to here and here to here. Since we're using a weight of the evidence approach, now we're looking at Nasdaq new highs, the percentage of Nasdaq stocks making new highs minus the percentage making new lows. We're looking at data going back to 1978. Once again, extremely rare to get down to this level here and then round trip it back to this level here. It's only happened 2 previous times. After the major low in 2009, this is after the financial crisis low, and after the major low in 2020 after the COVID crash. In both cases, the past actions of some traders allows us in the present day, because we understand the historical context now, to assess the probabilities related to other traders. Similar A to B moves have been followed by extremely satisfying long-term gains. Average gain 1 year later, 20%. 3 years later, 33%. 5 years later, 81%. 7 years later, 96%. And 10 years later, 172. And that speaks to the 2009 case. Another rare signal that's only happened a handful of times going back to 1990. This is the past action of some traders in 2025, driving this data set from the lower green line to the upper blue line. Historically, the subsequent actions of other traders and other investors push the market higher. It's only happened 5 previous times: 2009, 2012, 2016, 2019, and 2020. In every case, the market was higher a year later, 3 years later, and 5 years later. Median gain, 13% 1 year out, 37% 3 years out, and 86% 5 years out, with very consistent returns. Similar concepts here. Data set, NYSE stocks greater than their 200-day exponential moving average. It's a weekly chart. We check it every Friday. It's extremely rare to see a turnaround in sentiment, a rapid turnaround. This is a breath thrust here, and it happens very, very rapidly. Rapid moves have only happened a handful of times: 1991, 1995, 2012, and 2016. In all of those cases, the round trip from the lower blue line to the upper blue line occurred in less than 185 calendar days, which tells us market participants were bullish here. And then something happened, concern about tariffs, to make them become bearish, extremely bearish. And then something happened, the tariff news became less bad, that made them revert back to a bullish stance. After similar rapid moves in the past, the S&P 500 index, after the date of the signal just occurred in September of 2025, in every case, the S&P 500 was higher a year later, 2 years later, 3 years later, 4 years later, and 5 years later. Average gains 17%, 37%, 58%, 67%, and a little over 100%. Notice how consistent the returns are. The average and median returns, relatively close. Now we're looking at a similar data set. This is S&P 500 stocks greater than their 200-day exponential moving average. In this case, we're looking at a daily data set. Similar concepts: tariff fear, tariff news becomes less bad, breath thrust type activity, and these signals that we're covering this week are the follow-throughs that you would expect to see after the initial breath thrust. Notice in 2008 here, financial crisis, you never make it back to the top blue line, you never make it back to that line. First rally attempt in 2015, you don't make it back to the top blue line. We've touched the blue line several times in 2025. Subsequent performance, 1 year later, 80% of the cases higher. 3 years later, all 4 cases were higher. 5 years later, all 4 cases were higher. Median return, 84%. End of the financial crisis, Nasdaq stocks greater than their 50-day exponential moving average. We're looking at all of the data that we have. We have data going back to 2002. We go from extremely pessimistic to much more optimistic very rapidly. We just did something similar in 2025. Similar round trip has only occurred a handful of times after the major stock market low in 2009 post-financial crisis. After the major low that was made in October of 2011, European debt crisis, and after concerns were in the rearview mirror in 2016 related to Fed policy. Similar situation in 2019. The S&P 500 made a low on Christmas Eve 2018, and then early in 2019, the Fed became much more market friendly. This is after the COVID low, and this is 2025. Subsequent S&P 500 performance. All 5 cases, the market was higher a year later, 3 years later, and 5 years later. Median gain 1 year out, almost 20%. 3 years out, a hair over 47%. 5 years out, an eye-popping 93%. And it's noteworthy that one of the signal dates that we just covered was February 15th, 1991. Another signal was triggered on February 8th, 1991. That's similar to the date that we identified earlier this year. Based on past secular trends and market structures, we said the present day was similar to March of 1991 and October of 1958. Walking forward from March of 1991, taking a long-term perspective, rather than worrying about 100% normal and to be expected drawdowns, was very rewarding. The additional gain in the S&P 500 index, walking forward from March of 1991 to March 24th of the year 2000, an eye-popping figure shown on your screen, 310%. Thus, it's probably fair to say the signals that we just covered align nicely with all of the material that we've covered in these weekly videos since May of this year. They follow up nicely relative to the breadth thrust that we covered earlier this year, and they align extremely well with the secular trend thesis. Also noteworthy, occurs within the context of a secular trend, occurs within the context of a secular trend, and a secular trend. These types of returns here also align nicely with these remarks from Jim Paulson. He has a ton of experience on Wall Street. You can pause your video player to read this and this. Weight of the evidence approach, something that just happened. Source of the data here only happened a handful of times. 1975, 1982, 1999, 2009, 2020, 2025. 1 year later, the S&P 500 was higher in every case. Average gain, 18.24%. This is the topping process in the early stages of the dot-com bust bear market. This is Dow new highs minus new lows. The S&P 500 peaks right in here. And in the financial crisis case, the S&P 500 is peaking in here. It's probably fair to say that this turn here and this turn here really don't look anything like September 11th of 2025, shown on the right side of your screen. The longer a data set or market goes sideways, the bigger the move that we can expect to get when we either get a bullish breakout or a bearish breakdown. This data here goes all the way back to 2020. Similar breakout here, and here. Subsequent S&P 500 performance, shown on the bottom of your screen. It's also noteworthy that the S&P 500 came back here in 2025 and retested the breakout above this high from 2022. This is a constructive look, and this is a constructive look. As we noted recently, for clients, we're covering over 350 ETFs. So the concept shown on your screen that the long-term trend in small caps as of September 12th relative to the S&P 500 is still against small caps. This is the 200-week moving average here. We examine charts like this and data sets for over 350 ETFs. We're trying to look at all options, including foreign stocks. Is it possible that this ratio is going to improve? This 200-week moving average is going to turn up and price will move above? Absolutely, positively, yes. But right now, this doesn't look discernibly different from this period in 2023 or radically different from this period in 2017 and 2018. And we'll continue to review all 350 ETFs, including ACWX, the ETF shown on your screen relative to SPY, and see how things unfold. Based on the data that we have in hand today, we're still happy with our current allocations. It's also noteworthy, similar breadth thrust, ours occurred in April of this year. They don't typically mesh up with recessions occurring in the next 12 months. These are breadth thrusts going back to 1950. Here's the answer to the question on the right side of your screen. Also noteworthy, source of the data on the right side of your screen. When the Fed cuts in the context of an expansion, the average gain in the S&P 500 12 months later, 16.5%, with every single historical case higher a year later. And given what we know today, and given how the Fed operates, a 25 basis cut next week is about as near as certain as it can possibly be. It's just the way the Fed operates. They would have corrected this number if they weren't planning on cutting by at least 25 basis points on September 17th. Highest probability scenario is a cut in September and a second 25 basis cut in October. Now, obviously, these numbers out here are subject to and will change over time. But barring something highly odd occurring in the next few days, they're going to cut rates this week. And typically, that's good for the stock market when the economy is healthy. And clients and longtime loyal viewers know we don't make any assumptions about what's going to happen next. Let's say the S&P 500 drops down into this region here, then we're going to have to be willing to reassess the answer to that question about volatility to ignore or volatility to respect. In recent months, we haven't seen any of our guideposts violated, which makes it easier to withstand 100% normal and to be expected volatility. And the only way that we can use a chart like this effectively is if we had it a next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.